What's going on, everybody, and welcome back to the channel. In today's video we're going to be talking about what is going on with all this banks madness. We first saw the second biggest bank failure in history not too long ago, with First Valley Bank having to get seized by the government and nobody wanting to buy the bank, and eventually failing, and a lot of customers' funds getting locked up and frozen. Yes, they were certified up to $250,000, but a lot of those people that were holding money in that bank had millions and millions of dollars because the bank offered a lot of loans to big tech companies such as Coinbase, Chewy, and many other ones out there that were in the Silicon Valley Bank. Now, what has happened today and yesterday, we saw a new bank, which is First Republic, failing, and again, very similar to Silicon Valley Bank, not being able to afford those deposits. The main reason is because people were pulling their money out, and when people pull their money out, the banks have what we call a cash crunch. That means they don't have enough money in their reserve to support their business, because what they're doing with the rest of the money that was given to them was they put into bonds. Those bonds are currently down, or there are different other investments with the increase of interest rates putting a lot of pressures on those investments, and then being down millions and millions of dollars on such, and not being able to close them for a loss, and eventually they have to kind of go for close. And very similar to what we saw with Silicon Valley Bank, what happened, the Federal Reserve came and had to control this bank. The main difference between Silicon Valley Bank and First Republic is actually pretty big, where JP Morgan came in, they stepped in and made a bid for this bank and actually bought it up. What we saw with Silicon Valley was that no one wanted to buy the bank. They kind of just, nobody thought there was enough value there to pick it up even for cheap. So JP Morgan came in and now they bought this other bank. To note that also before this had happened, First Republic had seen a lot of cash issues in the prior quarter, and they actually had a $50 billion loan from JP Morgan. And even with that loan, they saw a decrease of over 35% of deposits, which means people were not depositing money with them anymore. They couldn't trust them. And when you're in the banking industry, the number one thing you have to worry about is, do people trust you? If they don't trust you, they will not give you their money because they're scared that you're not going to be able to give them back to them. And what is the beneficiary of all those is big banks. JP Morgan, Bank of America, Citibank, they're benefiting from this because the small banks, the local banks that you may see around your neighborhoods, or regional banks, are struggling. The people cannot trust the regional banks because they're too small, and they go elsewhere to the big banks. But what's really important about JP Morgan that people may not understand is that there's a law out there that it says that no one bank can hold over 10% of all the deposits in the whole United States. And JP Morgan currently holds more than 10%. And even with this law being there, the federal government did not want to step in and stop this purchase. The reason why they have the law is because they're scared if something ever happens to JP Morgan, that'd be 10% of everybody's money in the United States will be failing alongside the bank. We think, the second and now the third and then the fourth largest bank failures have happened within the last 3 to 6 months. This will negatively affect the stock market, but the stock market has been ripping. Why has that been the case? The reason why the market actually liked this is because they really enjoy what JP Morgan game plan is. If we look at the stock price of JP Morgan, which is the company that acquired First Republic, was actually up 3%. It gapped up. That means a lot of people were like, hey, we were like them buying these banks, and kind of making a monopoly almost, and we're gonna buy their shares. The reason is because in the short term, yes, it might put a stress on JP Morgan, a very slight stress, because you have to think about how much trillions of dollars JP Morgan really has acquiring these smaller banks, but they're actually buying these banks for pennies on the dollars, because JP Morgan expects interest rates to go up to 6%. We're currently around 5%. That'd be 1 more percent. So after that, once the rates start cutting, who's going to benefit the most? It's going to be JP Morgan acquiring a lot of these smaller banks and being able to profit after buying them on pennies on the dollars. And we have to think about the mindset the stock market has, or investors have. They're never thinking about what's going to happen in the short term, but they're usually investing for the long term. So it's priced in that the short term, there's probably going to be some pressure on the banks, but realistically, in the long term, it's going to be beneficial. Also thinking about who benefits from higher interest rates. A lot of times it's going to be bigger banks, such as JP Morgan, because guess what happens? Loans go higher, your auto loans, your home loans, your credit cards, everything goes higher, which means the consumers are going to have to pay the banks much more. Now, how does this affect crypto as well? We saw crypto actually selling off on this news. Now, crypto has been performing extremely well as the rest of the markets and kind of pretty much the stock market as well. but we saw a slight sell-off when this news was pretty much announced. The reason being is, people believe that everyone's moving their money from banks and putting it into Bitcoin. I think that's why Bitcoin has been going up. But in reality, that's not the truth. People are not doing that. The real reason Bitcoin has been pumping is because a lot of regulations may be coming out very soon, and people are scared that those altcoins that they're holding, a lot of those bag holding altcoins, might get completely destroyed. So what they're doing is moving those altcoins and putting them into Bitcoin. Make sure you're not in one of those camps that thinks, hey, holding my money into Bitcoin and crypto is a lot safer than a bank. Because as long as you're banking with one of those major banks, trust me, you're going to be fine. I'm not saying do not invest into Bitcoin and crypto. Those are great investments, but they're investments. So keep in mind the difference between holding your money somewhere, a bank, versus an investment, right? Because we saw what happened to a lot of different brokerage firms in that held crypto. You got your funds locked away, FTX, right, and a lot of those other smaller ones, and you never know what regulation may happen that might lock away your money in one of those trading platforms. So make sure you keep your savings and anything you want to save to buy something on your regular bank. And if you want to make an investment into crypto, make sure you're putting on a ledger, because I promise you a ledger and a bank are going to be much safer than keeping your money somewhere like Binance, Qcoin, and all those other platforms. So what is the moral of the story here? It is that JP Morgan might look like a savior here, but it's really just a way for them to make more money. Because they bought a company that has $309 billion in assets for only $1.9 billion. Yes, they might be in distress and they're going to have to do some cleanup, but in the long term, it's a great move for them. The markets like this, and unlike how this news sounds like, hey, these banks are failing, this other bank is failing, the markets don't really care of the banks failing. They just care about who's buying them and what's the results of all of this happening. And currently, it is still in the bullish cycle. I definitely don't think that the bear market is completely over. We're going to go to all-time highs right away. But currently, the market is in a bullish cycle, and they don't care at all what's happening with all this bank's dilemma. My advice for you is, if you have any money in regional banks, take it out. They're just not safe. Stick to those big banks, those credit unions, where your money will be insured. Don't keep your money in any type of crypto platform, because you never know what's going to happen. It's just way too dangerous right now, and you're not insured at all. Keeping your money in actually an investment platform, something like Thinkorswim, something like Robinhood, Webull, actually is a good option, because you're insured up to $500,000. $250,000 of that will be cash, and other $250,000 that will be if you own any shares. So for example, if you own $10,000 shares of Tesla, that will be part of that 250, and then the rest will be all in cash. So that's always a great option as you're trying to always keep some money in your brokerage, because if something sells off, you want to be there and buy for the cheap. Other than that, guys, hope you like this breaking down how these bank failures really affect the market, what are the next steps, and how did JP Morgan play a role in all this. Just know JP Morgan still will like for inflation to go even higher, so they can maybe scoop up some more deals for cheaper and make extra money on those loans that they give out. As always, guys, if you like more information on this stock market, crypto market, just finance in general, real estate, whatever it is, this is the channel to be. Make sure you hit the like button, subscribe, comment down below, and as always, peace.